Kathy Jones, the 10-year Treasury is now yielding about 2.5%. How much lower can it go?
Well, that's really going to depend on whether the economy bounces back after the slump in the first quarter or whether it continues to be on the soft side. I don't think there's a lot of downside from here just because real interest rates are really low right now. So I would guess maybe 230, 240 on the downside, but we'd really need to see the economic environment change a lot to get much lower from here.
Munis also had a great first quarter of the year. I think in your most recent note you said it hasn't been this good since the third quarter of 2011. Do you stick with that trade?
We still like munis. It's not as great a trade as it was 6 months ago, and we liked it then, but we continue to like munis. They're pretty fairly valued here, but the supply is really limited. Austerity at the state and local level means you have less supply. So relative to demand, the supply-demand balance is pretty good, so we still like munis.
The other thing you wrote in your most recent note is that you don't expect, quote, price appreciation from corporates, end quote. People love corporate bonds. That's what I keep hearing from everyone else. But you don't think you can get much money out of them?
Well, I think you can earn the coupon, and we don't expect
Not
a
much,
lot of...
That doesn't say much lately.
No, but in this market, earning the coupon is pretty good. We don't see a lot more spread tightening versus treasuries from here, but we think that in investment-grade corporates, you'll earn the coupon, and it's a reasonably good place to be invested right now. So it's not that we don't like them. We've had a couple of good years, and it'd be hard to duplicate that next year.
And that's investment-grade corporates. What about the triple hooks? What about the high-yield stuff?
Now, we're very concerned about high yield, and our big concern is we think people are too complacent about the risk. We've seen, the yield, say on the high yield index, is now right around 5%, which is an all-time low. And we think you should buy high yield when the yields are high, not so much when they're low, and real deterioration in the quality of new issuance. So we're very concerned that any small hiccup in the market is going to cause a backup in high yield.
So if you can't get high yield from a high yield, where do you find yield in this market? Is it in the REITs? Is it in the MLPs? Is it in all the acronyms?
Well, all those things give you some yield over, say, treasuries or maybe investment
BDCs,
grade.
I forgot that acronym.
Yeah, they are all providing some yield, but those sorts of sub-asset class instruments are going to trade probably a lot like bonds when interest rates go up because people are buying them as bond substitutes. There's a good chance they're going to be interest rate sensitive as well. So you have to be a little bit careful. They also tend to be less liquid than, say, a treasury or even investment grade corporate bond market.
So where do you find the yield then?
Yeah, I think you have to take the yield that the market gives you right now relative to the risk you're willing to take. And we're just telling people, make that trade-off, take some risk off the table, and accept the yield that you get. And
I know you're a bond person, but what about dividend-paying stocks? Because you might get 3% in a Dow stock, and you also can get that capital appreciation, that stock price moving up?
There's nothing wrong with dividend-paying stocks, but they don't behave like bonds, right? So you don't get the diversification in your portfolio. They're great for getting some yield in your equity portfolio, but they don't substitute for bonds.
All right, thanks a lot, Kathy.
Thank you.
Thank you for watching The Street.